Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are plugging into the single largest electric utility holding company on the planet. Lana, we're talking NextEra Energy.
NextEra Energy, ticker NEE. Market cap just under $196 billion, trading at $94.11, sitting right near its all-time high. This is the company that figured out how to make regulated utilities exciting.
And the timing could not be better. In March 2026, President Trump approved NextEra to develop up to 10 gigawatts of natural gas-fired generation in Texas and Pennsylvania, tied to Japan's $550 billion U.S. investment commitment. Add in the AI data center power boom, and suddenly this utility stock is the hottest infrastructure play on the street.
That's the setup. Let's break it down.
So here's the company overview. NextEra Energy was born in 1925 as Florida Power and Light. Today it operates through two principal business segments. The first is FPL, Florida Power and Light, a regulated utility serving over 6 million customer accounts across the Sunshine State. Think roughly 12 million Floridians getting their electricity from this one company.
And FPL is not just any regulated utility. It runs one of the most fuel-efficient and cost-efficient generation fleets in the country. Its non-fuel operating and maintenance costs are 70% below the national average, and it earns an 11.7% return on equity, well above the industry norm.
Then you've got the growth engine, NextEra Energy Resources, or NER. This is the world's largest generator of renewable energy from wind and solar. They've built a 30-plus gigawatt project backlog, and they operate on 15 to 20-year contracted revenue models through power purchase agreements.
That dual-engine structure is the core thesis. FPL gives you stability and predictable regulated earnings. NER gives you growth. Together, they reduce volatility compared to pure merchant power producers or pure renewables plays. It's the best of both worlds.
The company is headquartered in Juno Beach, Florida, employs about 70,300 people, and is led by CEO John Ketchum. Ketchum has been with NextEra since 2002, served as CFO of both FPL and NextEra Energy, ran NER as president and CEO, and took the top job in March 2022. He became chairman that July.
He's a lifer who knows every part of this business, and he's not shy about the vision. He's called NextEra a technology company that delivers electricity. Under his leadership, they've committed to an all-of-the-above energy strategy targeting 8+% annual EPS growth through 2035.
All right, Lana, let's get into your favorite part, the numbers.
Let's start with valuation. NextEra trades at a PE of 28.5 times trailing earnings. That's 66% above the utility sector median of about 17 times. The forward PE comes down to roughly 24 times based on 2026 guidance. Price to book is 3.08, EV to EBITDA is around 12.5 times, and the PEG ratio is approximately 1.25.
So it's clearly trading at a premium to the sector. Is that premium justified?
That's the central question. And the answer depends entirely on whether you believe the growth story. If NextEra delivers 8+% EPS growth through 2035 as guided, the premium is arguably deserved. No other utility comes close to that growth rate consistently. But if execution stumbles, you're paying a lot for a utility stock.
Fair enough. What about the income and growth picture?
Trailing 12-month revenue is $26.3 billion. Now, headline revenue growth was essentially flat at 0.2% year over year in 2025. But that's misleading. This is a capital-intensive business where revenue doesn't tell the whole story. The real metric is adjusted earnings per share. Full year 2025 adjusted EPS came in at $3.71, up 8.2% from $3.43 in 2024. Quarterly revenue breakdown. Q4 2025 was $6.5 billion, Q3 was $7.97 billion, Q2 was $6.6 billion, and Q1 was $5.2 billion. You can see the seasonal pattern. Q3 is the peak because Florida summers drive massive electricity demand.
Makes sense. Air conditioning is basically a survival tool down there.
On margins, gross margin is an impressive 64.4%, operating margin around 27%, and net profit margin is 24.7%. For a utility, those are elite numbers. The gross margin reflects the high proportion of regulated revenue where cost recovery is built into the rate structure.
And cash flow.
Free cash flow trailing 12 months is $3.7 billion. However, the FCF yield is actually negative at around negative 1.7% because the company is in a massive capital deployment phase. They're investing $94.2 billion between 2025 and 2030, roughly $58.6 billion into FPL generation, transmission, and distribution upgrades, and about $35.6 billion into NEE for new renewable projects.
So the negative FCF yield is a feature, not a bug. They're spending to build out the future asset base.
Exactly. Now the balance sheet, total debt is $97.2 billion. Net debt is $94.4 billion after subtracting $2.8 billion in cash. Debt to equity ratio is 1.46 and debt to EBITDA is rough 6.6 times. Total assets are $212.7 billion. The current ratio is 0.60, which indicates some short-term liquidity pressure.
That's a lot of leverage.
It is, but context matters. Regulated utilities have very predictable cash flows, which supports higher leverage ratios, and NextEra's investment-grade credit rating means they continue to access capital markets on favorable terms. The leverage is growth-oriented, not distress-oriented.
What about dividends?
This is where NextEra really shines for income investors. The annual dividend is $2.49 per share, yielding 2.69%. They've increased the dividend for 32 consecutive years. The 5-year dividend compound annual growth rate is 10.1%, and they just announced another 10% increase for 2026. Payout ratio is 68.5%. Comfortable, but not excessive.
32 straight years of increases at a 10% growth rate. That's not your grandfather's utility stock.
Overall, NextEra Energy's financial health is strong. Elite margins, consistent 8+% EPS growth, and a 32-year dividend streak growing at 10% annually, offset only by high but manageable leverage and a temporarily negative free cash flow yield driven by growth investments.
Now let's talk about what Wall Street thinks. Analyst Consensus on NextEra is a buy. Of the 16 analysts covering the stock, 11 rated a buy and 5 have it at hold. 0 sells. The median 12-month price target is $95.80, which from the current price of $94.11 implies just about 1.8% upside.
Which tells you the street thinks the stock is fairly valued here. But the range is wide. The low target is $85 and the high is $110. Goldman Sachs raised their target to $98 in January, calling it a best-in-class play for the AI power trade. Morgan Stanley maintains an overweight at 97, and Bank of America just raised their target to 95 from 87 on April 10th.
What about insider activity?
In the last 90 days, insiders sold about $17.1 million worth of stock, 190,816 shares total. Executive Vice President Charles Sieving sold 30,000 shares at $90, and Treasurer James May sold about 7,100 shares around the same price. Insider ownership is just 2.2%. Institutional ownership is 78.7%.
Is the insider selling a red flag?
Not in this case. The selling came as the stock was approaching all-time highs and appears to be routine diversification through planned disposition programs. It's normal profit-taking, not a signal of negative insider sentiment.
And the last earnings report, Q4 2025, released January 27th. Adjusted EPS came in at 54 cents, beating the estimate of 53 cents by a penny. Revenue was $6.5 billion, just barely missing the $6.52 billion estimate by $20 million. Not a blowout, but a clean beat on the bottom line.
Full year 2025 adjusted EPS was $3.71, up 8.2%, and the forward guidance is compelling. 2026 adjusted EPS of 3.92 to 4.02, targeting the high end, and 8+% annual EPS growth through 2035.
Let's also touch on options activity. The put-to-call ratio on NextEra is 0.38, meaning calls are being traded at roughly 4-to-1 over puts. That's decidedly bullish. Implied volatility at 28% is on the lower end of its 52-week range. Call volume was about 7,400 contracts. Traders are positioning for continued upside. All right, let's lay out the bull case and the bear case. Starting with the bulls, catalyst number 1 is the AI data center power demand story. NextEra's 30-plus gigawatt backlog at NEE is converting to operational assets right as electricity demand from AI and data centers is surging. This isn't speculative. Google signed a 25-year nuclear power purchase agreement, and Meta signed 11 separate solar and wind PPAs. These are real contracts with real revenue visibility.
Catalyst number 2 is the rate base expansion at FPL. The 2026 to 2029 Florida rate agreement locks in a 10.95% return on equity. FPL is planning $90 to $100 billion in investments through 2032 for generation, transmission, and distribution. Annual regulated infrastructure spending is expected to grow from $5 billion today to $18 to $22 billion by 2032.
Third, the 10-gigawatt natural gas expansion approved in March 2026 gives NextEra exposure to traditional power generation in Texas and Pennsylvania, diversifying beyond renewables while still growing the overall asset base.
And fourth, the dividend growth story is one of the best in the market. A 32-year streak, 10% annual increases, and the company is guiding for 6+% dividend growth going forward off the higher 2026 base. For income-oriented investors, that combination of yield and growth is rare.
Now the bear case. Lana, what keeps you up at night?
Risk number 1, regulatory and policy uncertainty. NextEra's growth engine at NEE depends on clean energy tax credits and favorable regulation. If those credits are eliminated or political support shifts materially, it could slow new project originations.
Risk number 2 is physical climate risk. NextEra's primary service territory is Florida, one of the most hurricane-exposed states in the country. Climate change is expected to make storms more severe and more frequent, which could drive higher storm recovery costs and pressure returns.
Risk 3, the leverage. $97 billion in total debt is not a small number. If interest rates stay elevated or rise further, refinancing costs could compress free cash flow and potentially pressure the dividend growth trajectory. The current ratio of 0.60 means they're running lean on short-term liquidity.
And risk 4, execution on the backlog. 30-plus gigawatts of projects sounds fantastic, but actually building them out requires permitting, supply chain availability, and labor. Delays could mean earnings miss versus that ambitious 8% growth target.
The fifth risk I'd flag is AI demand uncertainty itself. Yes, data center power consumption is surging now, but an unforeseen slowdown in AI capital spending or a consolidation of data center locations into regions not served by NextEra could reduce the demand runway.
Good. Now let's put NextEra in context against its peers: Duke Energy, Southern Company, and American Electric Power. Starting with valuation, NextEra's PE of 28.5 times is a meaningful premium to Duke at 21 times, Southern at 24.8, and AEP at 20.5. NextEra is the most expensive of the group.
On revenue growth, the picture inverts. AEP is actually leading at 10.9% growth, Southern is at 9.4, Duke at 6.2, and NextEra's headline revenue growth was essentially flat. But again, adjusted EPS growth of 8.2% is the real metric for NextEra, and on that basis, it's among the leaders.
What about margins?
NextEra's net margin of 24.7% is significantly above Duke at 15.6%, Southern at 14.7%, and AEP at 16.4%. NextEra is the most profitable utility in the group by a wide margin. On dividend yield, Duke leads at 3.22%, Southern is at 3.7%, NextEra at 2.69%, and AEP at 2.79%. You're giving up some current yield with NextEra in exchange for superior dividend growth.
And they're all carrying heavy debt. Duke's debt to equity is 1.7, Southern's is 1.91, AEP's is 1.54, and NextEra's is 1.46. All three peers also have negative free cash flow, Duke at negative $2 billion, Southern at negative $3.5 billion, and AEP at negative $5.1 billion. The entire utility sector is in build-out mode.
What separates NextEra is the combination of premium margins, the renewables growth platform, and the contracted revenue visibility that peers don't match at scale.
All right, let's bring it home. The bottom line on NextEra Energy: this is the premium utility stock, trading at a premium valuation because it delivers premium growth, 8+% EPS growth, a 32-year dividend streak growing at 10%, and the world's largest renewable energy pipeline converting just as AI power demand explodes.
The single most important number to watch is backlog conversion. NextEra has over 30 gigawatts in its pipeline. The pace at which those projects move from contracted to operational will determine whether the 8% plus EPS growth target holds through 2035 and whether this stock's premium valuation is justified.
Before we close, I want to remind everyone you can find all our episodes, show notes, and financial breakdowns at chargedalpha.com. Every company in the S&P 500, one deep dive at a time. If you're enjoying the show, share it with someone who wants to understand the market better.
Subscribe wherever you get your podcasts so you never miss an episode.
And we want to leave you with a quote from the man running the show at NextEra. CEO John Ketchum said, "We firmly believe in order to meet historic power demand, we are going to have to come up with all of the above energy solutions. Renewables are ready to go right now because they have been up and running."
I love that framing. Not ideological, just practical. Renewables aren't the future for NextEra. They're the present that funds the future.
That's our deep dive on NextEra Energy, the world's largest electric utility, powering the AI revolution 1 gigawatt at a time.
Stay plugged in.
This is Charged Alpha, the S&P 500 stock encyclopedia. Charged Alpha is produced for informational and educational purposes only. Nothing in this episode constitutes investment advice, a recommendation, or a solicitation to buy or sell any security. All financial data is sourced from public filings, analyst reports, and third-party data providers, and is believed to be accurate as of the recording date, but is not guaranteed. Past performance does not guarantee future results. Always do your own research and consult a licensed financial advisor before making investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed. This episode was produced with the assistance of artificial intelligence tools for research, scripting, and audio generation.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall